I want you to think about something for a moment before we get into the numbers. Think about the last time you sat in a Social Security office, or called the Social Security Administration helpline, or read through the official SSA website trying to understand your benefits. Think about what that experience felt like. The forms, the language, the waiting, the sense that you were navigating a system designed by people who had no particular interest in making it easy to understand. Now I want you to think about how much money rides on your ability to understand that system correctly. Because the 3 Social Security rules I am going to walk you through today are not obscure technicalities that apply to a small subset of unusual situations. They are rules that apply to millions of ordinary American households right now in 2026. Rules that have either changed recently, been consistently misunderstood for decades, or that interact with other parts of the retirement income system in ways that produce financial consequences far larger than most people anticipate when they make the decisions these rules govern. The Social Security Administration processes approximately 10,000 new retirement benefit applications every single day. The majority of those applicants make at least one of the 3 decisions I am about to describe in a way that costs them thousands, in some cases tens of thousands of dollars in lifetime benefits, compared to the outcome an optimized strategy would have produced. Not because they are careless, not because they did not try to get it right. Because the rules are genuinely complex, the information provided by the SSA is technically accurate, but strategically incomplete. And nobody in the application process is legally required or financially incentivized to tell you that the decision you are about to make is going to cost you $60,000 over your retirement lifetime. This is Retire Right America, and today we are going to close that information gap for good. Let me give you a family before I walk you through the 3 rules. Their name is the Brennans. Patrick Brennan is 66 years old. He spent 29 years as a fire captain in a mid-sized city in Ohio. He retired from the fire department at 58 with a public safety pension. His wife, Catherine, is 64. She spent 22 years as a licensed practical nurse before leaving the workforce at 55 to care for her aging parents. Patrick and Catherine have been together for 41 years. They are careful people. They are the kind of people who read the instructions. When Patrick turned 62, he called the Social Security Administration and asked about his benefits. He was told his full retirement age benefit was approximately $2,100 per month. He was told he could claim early at 62 at a reduced rate or wait for a higher rate. He was told about the earning test that applies if he claims before full retirement age while still working. He was given accurate information, but the information he was given did not include 3 things that would have dramatically changed every claiming decision he made over the subsequent 4 years. The first thing he was not told is how his public safety pension interacts with his Social Security benefit through a rule called the Windfall Elimination Provision. The second thing he was not told is how his decision about when to claim affects Catherine's survivor benefit for the decades she is statistically likely to spend as his widow. The third thing he was not told is how the provisional income calculation will interact with his Social Security benefit once his pension, his RMDs from a small IRA, and his Social Security check are all running simultaneously, and what income management strategies could have reduced the taxation of his benefits by thousands of dollars per year. Patrick and Catherine are now 66 and 64. They have already made several of these decisions. Some can still be corrected or optimized, others cannot. I'm going to walk through all 3 rules so that you understand exactly where the Brennans are, what their remaining options are, and most importantly, how you can avoid making the same decisions they made if your claiming window is still open. The first rule is the Windfall Elimination Provision, and I want to spend significant time on this one because it affects approximately 2 million Americans and is misunderstood by the majority of people it applies to, including many of the financial advisors who are supposed to guide them. The Windfall Elimination Provision, which the SSA abbreviates as WEP, reduces the Social Security benefit of workers who receive a pension from a job that was not covered by Social Security. Federal employees hired before 1,984, state and local government employees, teachers, firefighters, police officers, and certain other public sector workers in states where the employer did not participate in Social Security may be subject to WEP. Patrick spent 29 years as a fire captain in Ohio, where firefighters are covered by the Ohio Police and Fire Pension Fund rather than Social Security. His pension is substantial, approximately $4,200 per month. But Patrick also worked private sector jobs before and after his fire department career that were covered by Social Security, accumulating sufficient quarters of coverage to qualify for a Social Security benefit. Here is what WEP does. The standard Social Security benefit formula is progressive, meaning it replaces a higher percentage of pre-retirement income for lower earners than for higher earners. The formula applies three different replacement percentages, called bend point percentages, to different portions of your average indexed monthly earnings. For most workers, the first bend point percentage is 90%, meaning Social Security replaces 90 cents of every dollar of your lowest earnings up to the first bend point amount. For workers subject to WEP, that first bend point percentage is reduced from 90% to as low as 40%, depending on how many years of substantial Social Security covered earnings you have. The reduction can cut your Social Security benefit by as much as $587 per month in 2026 for workers with fewer than 20 years of substantial covered earnings. Patrick had approximately 15 years of Social Security covered employment spread across his pre- and post-fire department career. His WEP reduction in 2026 is approximately $490 per month. His Social Security benefit that he expected to be around $2,100 per month is actually approximately $1,610 per month after the WEP reduction. Patrick did not learn about WEP when he called the SSA at 62. He learned about it when his first Social Security check arrived, and it was $500 less than he expected. The financial damage from the uncorrected WEP surprise was not just the lower monthly check. It was the downstream impact on his claiming age decision. Patrick had planned to delay claiming until 68 to capture the delayed retirement credit and maximize his monthly benefit. If he had known his benefit was going to be $490 lower than projected due to WEP, he might have recalculated the delay break-even analysis and made a different decision about when to claim. The WEP calculation is available through the SSA's online WEP calculator, which I strongly recommend every public sector worker or former public sector worker use before making any Social Security claiming decision. If you have ever worked for a state or local government employer, a federal agency, a school district, a fire or police department, or any employer that had its own pension system instead of Social Security, you need to run the WEP calculation before you assume your Social Security statement accurately reflects what you will receive. There is a companion provision to WEP called the Government Pension Offset, or GPO, that applies specifically to spousal and survivor Social Security benefits, and that is, if anything, even less understood and even more financially damaging than WEP. The government pension offset reduces the Social Security spousal or survivor benefit of a person who receives a government pension from a job not covered by Social Security by 2/3 of their government pension amount. Catherine Brennan spent 22 years as a licensed practical nurse. Her own Social Security benefit based on her nursing career earnings is approximately $1,200 per month at her full retirement age of 67. But Catherine is also potentially entitled to a spousal benefit based on Patrick's record, which would be 50% of Patrick's full retirement age benefit if that spousal benefit is higher than her own earned benefit. And after Patrick dies, Catherine would be entitled to a survivor benefit equal to Patrick's full benefit. However, Catherine also receives a small survivor pension from her parents' estate situation. Wait, let me correct that. In Catherine's case, the GPO does not apply because her nursing career was covered by Social Security. But for the millions of Americans who have a government pension from non-covered employment, the GPO can eliminate the spousal or survivor Social Security benefit almost entirely. A spouse who receives a government pension of $3,000 per month from non-covered employment has their spousal Social Security benefit reduced by 2/3 of $3,000, which is $2,000. If the spousal benefit would have been $2,000 per month, it is entirely eliminated. If the survivor benefit would have been $2,500 per month, it is reduced to $500 per month. The GPO is the reason many public school teachers, government workers, and public safety employees are shocked to discover that the spousal Social Security benefit they expected to receive after a spouse's death is dramatically smaller than the Social Security statement implied it would be. Before any couple where one spouse has a government pension from non-covered employment makes a Social Security claiming decision, both the WEP calculation and the GPO calculation need to be run and factored into the analysis. The SSA has calculators for both on its website. A fee-only financial planner with Social Security optimization expertise can run these calculations as part of a comprehensive claiming strategy analysis. This is not optional if you are in a household affected by either provision. It is the foundational step that every other claiming decision depends on. The second rule is the earnings test. And while many people have heard of it, the specific mechanics, the specific thresholds, and most importantly, the specific recovery mechanism that the SSA almost never volunteers, are consistently misunderstood in ways that lead to suboptimal decisions. The earnings test applies to Social Security beneficiaries who claim benefits before their full retirement age and continue working. In 2026, if you claim Social Security before your full retirement age and your earned income exceeds approximately $22,320 per year, your Social Security benefit is reduced by $1 for every $2 of earned income above that threshold. In the year you reach full retirement age, the threshold increases significantly, and the reduction is $1 for every $3 above the higher threshold. After you reach full retirement age, the earnings test no longer applies, and you can earn any amount without affecting your Social Security benefit. Most people understand this basic structure. What most people do not understand is what happens to the benefits that were withheld due to the earnings test. They are not lost, they are deferred. The SSA recalculates your benefit at full retirement age to account for the months during which your benefits were withheld, permanently increasing your monthly benefit going forward. If you had 12 months of benefits withheld due to the earnings test before reaching full retirement age, your benefit at full retirement age is permanently increased as if you had delayed claiming by approximately 12 months. The recovery is not complete and immediate in all cases, and the precise recalculation depends on the specific months of withholding. But the key point is that the earnings test is not purely punitive. The withheld benefits are partially recovered through the benefit recalculation at full retirement age. This changes the calculus for workers who are between 62 and full retirement age, still working, and considering whether to claim early despite the earnings test. If you claim early, earn above the threshold, have benefits withheld, and then receive the recalculated higher benefit at full retirement age, you are in a materially different situation than if you simply believed the withheld benefits were gone forever and made your claiming decision based on that incorrect belief. There is a second dimension of the earnings test that catches people by surprise, and that has ruined the finances of retirees who did not read the fine print carefully enough. The earnings test applies to all earned income, not just income from your primary employer. Consulting fees, freelance income, self-employment income, and any other compensation for services you perform all count toward the earnings test threshold. A retiree who claims Social Security at 63, works part-time for $25,000 per year, and also does occasional consulting for $10,000 per year, has $35,000 of earned income, not $25,000. The entire $35,000 counts against the earnings test threshold. If they did not account for the consulting income when they decided to claim early, the benefit reduction will be larger than they expected. The SSA monitors this through tax return data and W-2 and 1099 reporting. And if you underestimate your earnings in a given year, the SSA will withhold additional future benefits to recover any overpayment. The practical advice is to run your expected earnings estimate carefully and conservatively before claiming early if you have any income from work, and to account for every source of earned compensation, not just your primary employer's W-2. The third rule is the provisional income taxation of Social Security benefits. And while we have covered elements of this in previous Retire Right America videos, I want to go deeper in this video specifically because of two changes in the 2026 tax landscape that are affecting this calculation in ways that were not fully anticipated by most retirement income planning models. As I described earlier in discussing the Brennan family, the provisional income calculation determines what percentage of your Social Security benefit is subject to federal income tax. Provisional income equals adjusted gross income plus tax-exempt interest plus 50% of Social Security benefits. Below $25,000 for single filers and $32,000 for married couples, 0% of Social Security is taxable. Between $25,000 and $34,000 for single filers, and between $32,000 and $44,000 for married couples, up to 50% of Social Security is taxable. Above $34,000 for single filers and $44,000 for married couples, up to 85% of Social Security is taxable. These thresholds have not been inflation adjusted since they were set in 1983 and 1993 respectively. This is not an accident. The lack of inflation adjustment means that every year, as Social Security benefits increase with inflation, and as retirement income from other sources grows, more retirees cross the thresholds and a larger percentage of their benefits become taxable. In 1983, the provision was intended to affect a small minority of high-income Social Security recipients. In 2026, the majority of Social Security recipients with any meaningful retirement income from pensions, IRAs, or investments are in the 85% inclusion range. The provision has become a broad middle-class tax through the mechanism of inflation bracket creep, and nobody in Washington has any financial incentive to fix it because the revenue it generates is enormous. The 2026 change that is affecting this calculation in ways most retirement plans have not fully incorporated is the interaction between the senior bonus deduction created by recent tax legislation and the provisional income calculation. The senior bonus deduction, which provides an additional standard deduction amount for taxpayers 65 and older, reduces taxable income directly, but it does not reduce provisional income because provisional income is calculated before the standard deduction is applied. This means that a retiree who receives the senior bonus deduction and consequently has lower taxable income and a lower tax bill than expected may still be subject to 85% Social Security inclusion in the provisional income calculation, creating a situation where the effective marginal tax rate on the last dollar of IRA withdrawal, or RMD, is significantly higher than the marginal rate implied by the bracket alone, because that last dollar of income is also causing additional Social Security benefits to become taxable at the 85% inclusion rate. The interaction between the deduction and the provisional income calculation is technical, but its financial impact is real and measurable. A fee-only CPA or financial planner who does retirement income planning specifically can model this interaction for your specific income level and identify the income management strategies, Roth conversions, municipal bond substitution, qualified charitable distributions that reduce your provisional income and consequently reduce the amount of your Social Security benefit that is subject to tax. Patrick Brennan, our retired fire captain from Ohio, is currently experiencing all three of these rules simultaneously. The WEP reduced his monthly Social Security benefit by approximately $490 compared to what the statement projected before the pension was factored in. The earnings test affected 2 years of his benefit while he did part-time consulting work in his first years of retirement. And the provisional income calculation is causing approximately 85% of his remaining Social Security benefit to be taxable because his pension income of $4,200 per month stacks on top of his Social Security and RMD income in a way that pushes provisional income well above the $44,000 married filing jointly threshold. The three rules together are costing the Brennan household somewhere between $8,000 and $12,000 per year in combined benefit reductions and avoidable taxes compared to what an optimized strategy would produce. Some of that damage is permanent because certain decisions were made without complete information 4 years ago. But the provisional income management strategy, which can be implemented immediately through income source restructuring and IRA withdrawal timing, can reduce the ongoing tax burden on Patrick's Social Security benefit starting with the current tax year. And for any viewer of this video who is still in the claiming decision window, understanding all three rules before submitting a Social Security application is the difference between a lifetime of optimized benefits and a lifetime of avoidable reduction. Go to the comment section right now and tell me whether you have ever worked for a public sector employer with its own pension system instead of Social Security. Tell me whether you have run the WEP and GPO calculations through the SSA's online tools. Tell me your age and whether you have already claimed Social Security or whether the decision is still ahead of you. And tell me whether anyone has ever explained the provisional income calculation to you in the context of your specific retirement income sources. Because what I hear constantly in the Retire Right America community is that people have never had this conversation with anyone before it was too late to change the decisions that the conversation would have affected. Drop your situation in the comments. We analyze the exposure together. Like this video if the WEP or provisional income mechanics showed you something about your own Social Security situation that you had not seen clearly before. Subscribe to Retire Right America and hit the notification bell so every survival guide we produce reaches you before the relevant claiming window closes. Share this with someone who is within 5 years of their Social Security claiming decision and has not yet spoken with a fee-only advisor who specializes in Social Security optimization. The rules are complex. The stakes are enormous, and the information gap between what the SSA tells you and what you need to know to make the optimal decision is exactly the gap that Retire Right America exists to close. This is Retire Right America. Stay informed, stay protected, and claim every dollar you have earned.